Thank you all for taking the time to join this monthly session. As usual, the aim of this is to have a live session together to bring you what we have seen happening in the market of B2B software, IT services, tech-enabled. A lot going on these days, and the goal is to spend a little bit of time to decipher what the hell is going on. Beyond going through some of the high-level learnings from the past few weeks, so this is covering the month of March, we'll be going into a few deeper content topics today. Number one, including a new guest that some of you may have met in the past on projects, but for those of you attending the session, a new face of Dedale with Soukeyna, our topic lead on the healthcare tech side, that will bring us her synthetic view on where we see AI disrupting, enabling this super interesting verticalized area of the B2B software and technology market. Then I'll share with you a bit of a perspective on what we've seen happening in Q1 from a transaction perspective, as we have the final numbers of what we've seen going on. Then Ignacio and Rambo will give us a bit of a perspective on AI, plenty of things going on to stay up to date overall. And Miguel will share with us a view on the earnings, including layoffs, which is back in fashion. So we'll give you the numbers on what is happening and what are the announcements around that. First of all, let's go into what has been going on in the public markets for the month of March. Thank you, Rambo. Next page, we're going to look at performance, looking at our basket of 259 B2B software and technology companies that are listed in Europe and North America, that we slice and diced by type of company that they are. So you can see the different buckets appearing. On the left-hand side, at the top, you can see the monthly performance for last month of March. So you can see we are in continued contraction mode. The B2B software universe that we track is down just under 5%, in line actually with the wider public market indices, S&P 500, NASDAQ, aligned -5%, so it's bad months overall across the board. But when you take a step back looking at year to date, so this is just Q1 performance of the index and the wider market, you can see that overall public markets are in negative territory in 2026 so far. S&P 500 -5%, NASDAQ -7%. But when you look at the B2B software universe, and these are the bottom left chart, you can see -22%. So this is super heavy correction for the sector. And when you look at things on a weighted basis, this is different from what we've been commenting in the past. You can see that this is down 15% plus as well, because the majors are in steep decline. You can see year to date, majors is that first cohort on the right, -15% decline. We have not seen that for years. Those were continued to show good strength. They are down as well. When you look at things from a cluster by cluster perspective, you can see it's across the board. So the market is not sorting out winners from losers anymore. You can see a bit less negativity in infrastructure software, for example, which is down a bit less, but you can see that this is a big overall market reaction, probably with a bit of sorting out to do in the market to figure out the winners from the losers. And we expect to see that probably in the next few weeks and months. Let's have a look at what that means from a multiple perspective, because this is attractive time. Let's have a look at this with Julia.
Thanks, Ben, and hello, everyone. So valuations of EV over sales is down 5% since February to 4.0 times in March. From a year-to-date perspective, valuations are down 29% from 4.6 times at the start of the year. And from the valuation perspective as well, multiples are trading at multi-year lows at levels last seen in Q1 2017. Given the global geopolitical situation, we remain cautious. But from a value perspective, however, as last month, this continues to be a good opportunity to look at names with good fundamentals and with minimal AI disruption risk. Similar trend can be seen in EV over EBITDA, because it declined from 20.4 times in 2025 to just 14.1 time in March, lowest level ever seen since 2016. If you go to the next slide, The fundamentals remain the same when we look at EV over sales by valuation cohort, with higher growth companies still valued at higher multiples. But all cohorts are down year to date in EV over sales by more than 25%, with the highest growth cohort at 7.1 times, the mid growth cohort at 3.6 times, and the low growth cohort at 2.9 times. If we go to the next slide, as a reminder for the B2B software universe, we base the rule of 40 on revenue growth plus free cash flow margin. So here we look at the valuation by type of rule of 40, and they continue as well to decline across all rule of 40 cohorts. So the dark line here represents companies with the rule of 40 or above, and they are currently valued at 7.0 times EV over sales on average. It's stabilizing since February, and the valuation of the rule of 20-30 is even lower at 3.1 times, and even lower for rule of 20 companies now trading below at 2.6 times. If we go to the next slide, as for EV sales to growth versus EV sales to free cash flow margin, since May 2023, revenue growth has traded at a significant premium to free cash flow margins. This valuation spread peaked at 77% in March 2025, but now compressed to 37% in March 2026. While the market still values top-line expansion, the premium relative to cash flow is clearly normalizing. If we go to the next slide, here the narrative remains the same since last month. So the premium for North American companies continues to be elevated in March 2026 versus European ones, with the premium at 83% in March of US versus Europe. And if we go to the next slide, moving to the macro perspective here, US inflation cooled, stabilized at 2.4% from January to February 2026, down from 2.7% in December. However, it's still above the Federal Reserve's 2% target. Both the ECB and the US Fed held rates. This tells us that once again, as last month, that the decline in valuations isn't necessarily because of interest rate or rising inflation, but it is caused by other macro factors, which we, of course, know well now, AI disruption risk and broader geopolitics. Now, leaving it to Soukeyna to do a deep dive on the healthcare topic.
I will be spending a little bit of time on the health tech space, but to be fair, before we jump in, I think it's important to highlight that in a context where AI is seen as a disruptor for many software industries, health tech stands out as a space with a level of resilience that few other verticals actually offer. So it is one of the reasons why we've seen increasing interest for the healthcare IT vertical, and I think an important point to keep in mind as I move forward with this section. So if we start by covering investment activity in the space, over the last 3 months, VC funds dominated deal activity in health tech ecosystem, while corporates were the second most active group, using M&A to fill offering gaps or expand beyond their borders. So we tracked about 100 deals over the period, and 60% of those deals were venture and growth transactions, reflecting sustained investor appetite for emerging vendors complementing core healthcare IT platforms. Here by core platforms, I mean the foundational systems that hospitals or, for example, your GPs run on from a day-to-day standpoint. So here you can think about electronic medical records or practice management system for your GPs. So think Epic system or Compute Group Medical in Europe. So one of the key underlying drivers behind this is the post-COVID realization that these core systems leave operational efficiency gaps in the context of burnt out practitioners and medical staff. So for instance, you have NEA that led a $125 million Series B into Qualified Health, which is a clinical AI tech infrastructure platform enabling hospitals to integrate AI applications more easily in their tech stack and unlock efficiency gains throughout the patient journey. Now, corporates accounted for roughly 35% of deals, and beyond, I would say, like-for-like M&A plays, we observed 3 distinct acquisition patterns in the industry. The first one is expansion into adjacent care settings. So, for instance, you would have a hospital IT software vendors entering the clinical workflow IT space, but for elderly care facilities, for example. The second pattern that we typically see in the industry is offering scope expansion but within the same clinical setting. And the third one would be international expansion, which, to be fair, remains the preferred route to enter new geographies, given the need to tailor products to local regulatory and clinical pathways. So over the past 3 months, actually, several transactions illustrated those patterns. So one of the largest corporate deals that we've actually closely tracked was the RadNet's acquisition of Glimmer, which is a clinical imaging AI solution for $270 million to expand its portfolio of AI-powered medical imaging products. On the international expansion plays, well, you would have the leading French radiology software specialist, EDLs, which acquired Mesalvo's DACH radiology software unit in order to penetrate the region. Now, on the LBO side, LBO represented approximately 5% of deals. For the health tech industry, it is worth noting that the pool of buyout targets is overall structurally constrained, and so for several reasons. The first being that most scale players sit in mature niches with 10 to 15-year replacement cycles and high switching costs, which overall limits customer acquisition and scale in the space. Another reason is that the vendors that do successfully scale tend to become acquirers themselves, and here think Dedale and CGM, which then further narrows the pool of LBO targets. We, however, over the last 2 years, note a large buyout acquisition. So we have Veritas Capital, which acquired a majority stake in GHX in January. GHX is a healthcare supply chain platform, and official reports actually report a $5 billion valuation, which is quite significant in this space. Now, if we move on to the next slide, a relevant point to contextualize deal activity is where healthcare facilities intend to direct their tech spend and how that tech spend will evolve, actually. So we have conducted a survey with CIOs of care facilities, which showed that first 56% of facilities expect to increase their budget for new technologies over the next 3 years. Now, on where that budget is going specifically, spending intent will increasingly flow towards health tech capabilities, where cost savings and incremental revenue potential are directly measurable. So here on capabilities that actually translate into hard dollar ROI for facilities. In terms of the top 2 categories, so both scoring 64% of stated investment priorities, number 1 was automated clinical documentation. So here tools that generate clinical notes and reports from physician-patient interactions. And the second one was AI-powered medical imaging. Then you had predictive analytics, which followed at 57%. So here you can think about developing an AI that's able to predict lengths of stay to then optimize bed management, which is something that Epic System did. What is notable here is basically the alignment between deal activity and stated spending priorities. So some of the largest transactions over the last 3 months actually cluster around some of the largest top ROI priorities. For example, we have Glimmer in AI imaging, we have Qualified Health in clinical AI infrastructure, we have Latent Health in clinical decision support, for example. We also have ID Health acquisition of Automatica, which is something that's worth flagging, because post-deal, the combined scope of ID Health is clinical decision support system, automated medical documentation, and patient communication, which effectively covers multiple of the top ROI categories. So tracking where the spend of the healthcare facilities will concentrate is actually a good indicator of future deal activity to some extent. Now, if we move on to the next slide and we tackle the AI disruption risk, of course, the question that we have is how exposed is the healthcare IT incumbents when it comes to AI? The short answer is that, again, healthcare IT is structurally more protected than most sectors. You have regulatory oversights, the need for deep local and domain expertise to build products that drive user adoption, and of course, you have a very high cost of failure, which creates meaningful barriers to disruption. That said, when we zoom in core systems specifically, this disruption risk is not uniform. It is relatively higher in segments defined by repetitive tasks, with higher exposure for clinical decision support and augmented visualization software, and lower exposure in mission-critical platforms with high switching costs, like hospital information systems, and PACS, meaning picture archiving and communication systems, typically used in radiology use cases. Importantly, though, even in the more vulnerable segments, disruptors tend to be healthcare specialists themselves and not the generic AI players that we typically hear about, such as ChatGPT or Anthropic in a way. So in segments like clinical decision support and augmented visualization software that are driving high interest from AI native disruptors, incumbents have actually already started to adjust their product strategy to defend their share. So for example, you would have Elsevier, which launched Clinical Key AI to defend their positioning on the CDSS segment. Now for the more protected sub-verticals, again, hospital information systems and PACS, those that are deeply embedded systems of records, serving as the mission-critical source of truth for patient data. If those systems shut down, the facility can actually shut down. So here, the demands for high accountability and low tolerance of error deeply protect those niches. And then you have those verticals that are in between. So the practice management software, and those exhibit an actual medium disruption risk. It is indeed repetitive administrative tasks with comparatively low cost of failure, but here risk is moderated by high practitioner inertia, meaning that they tend to stick with whatever vendor they typically have. So overall, the broader takeaway here is that established vendors are more likely to expand contract by adding AI capabilities in their scope, or to integrate with those new emerging AI native endpoint solutions than to actually be replaced by those new AI emerging vendors. So I hope that this section on healthcare IT was insightful, and on this, I'm passing the mic to Ben to speak on deals.
Thank you very much, Soukeyna, for this update. As you start to see, Soukeyna is a pro and can go much deeper for very long hours on this topic. So don't hesitate following this chat if this area is of interest to go for one-on-ones with Soukeyna. She has worked on many of those deals as well if you want to go deeper. Let's continue with the second part of a bit of an update today, looking at transaction. First, sharing with you a new view that we will provide you on a quarterly basis. You've been asking us for quite a while, and now we have been able to work on it, and we feel we have enough like statistical data to be able to show this to you. So we're quite excited about this. You've been telling us for quite a while, can you please update us on what you see as areas being hot in the market? And now that we are working with many of you in the community, investors, corporate, M&A, we track in terms of all the engagement touch points we have, from all the way deep projects to light engagement on specific situations, try to track where those are to be able to give you an overall perspective. Well, in Q1, we have over 250 of those, which start to give a little bit of good statistical relevance as to where is the heat in the technology market at the moment. And we want to give you a bit of that radar approach of what is hot. The darker the color, the hotter it is. Number one, first key message to pass on to you is the hottest area by far on our side in Q1 has been the GRC segment, both as a horizontal, so GRC in every single company or corporate or administration on the planet continues to be a core topic, but also looking at things from a vertical perspective. We've seen a lot of interest, a lot of appetite on all maturity cycles, both North America and Europe. So by far the most hot topic at the moment. Then also hot, we have the where money flows topic that continues to be attractive, looking at things from a vertical perspective, so financial services broadly as an end market, including core banking, wealth management, capital markets, looking also at insurtech, continues to be active overall, both buyout and growth. And when you look at things from a horizontal perspective, Office of the CFO, ERP, and all the sub-modules inside continues to be an attractive and hot area as well. Then can mention other verticals that are very much anchored in the physical world. So for example, construction and prop tech, seen as relatively defensible from a vertical perspective, but also with some new gen opportunities, seeing a lot of interest. We can mention industrial and engineering as well. By extension, the supply chain ecosystem continues to see interest. And going back to Soukeyna's world with healthcare, that has also seen a good interest. Then when we look at horizontals, we can mention CRM, CMS marketing, human capital management. Those are very wide markets that continue to be very active, a lot of questioning around AI disruption, incumbents that can continue to sustain, new gen vendors that are coming up, a lot of questions there, but a lot of things going on as well. And we continue to see good traction overall in those domains. One final one, it's a gray box, but seeing renewed interest on that. It's the whole data and intelligence layer. It is seen as an area that is going to be more attractive and valuable than ever going into the AI world. And for that reason, many parties are going deep into the data layer of those horizontals and verticals as well. Now, let's go a bit into the numbers of transaction. If we go to the next page, first of all, showing you the final numbers for Q1 2026. This is the sliced view of looking at private equity investing in 2026. On the right-hand side, you can see Q1 numbers. The highlight overall is it's a good start in terms of value, a slower start in terms of volume, and we feel qualitatively a super polarized approach in terms of private equity investing. We do see good traction since the start of the year in small and mid cap, but because of what is going on in the public markets, difficulty of pricing assets, questioning around AI defensibility of software overall, large buyout is very quiet. So after having good momentum at the end of last year, things are going back to a bit of a wait and see approach. And Q2 is on the softer side from what we can start to see at the moment. Now going into the second category on the next page, looking at corporate M&A, it's a bit of a similar signal as well. In terms of volume and value, it's a relatively slow start to 2026. Same big corporates that have been hammered for some of them from a multiple perspective have trouble pricing a new acquisition asset. We continue to see good activity from the consolidator side of things that are actively looking for like value type entry points because the market is seen as a little bit cheaper than it was. Nevertheless, we do also feel some wait and see mode in the market. And finally, looking at things from the venture and growth world, on the next page, yep, you can see that the trend, like the medium-term trend in terms of volume of deal continues. So relative smaller and smaller number of deals in the growth and venture world. However, in terms of value, continue to see huge amounts of capital being deployed, but this is all around AI and the mega deals around AI that continue. And to go a little bit deeper into that, I will pass it on now to Ignacio.
Hello, everyone. So this is the top-down analysis focused on AI-related deals made in March of 2026, as well as the 2026 year-to-date. So jumping right into the full picture here, 2026 has had a very strong start to the year with already around $210 billion in total AI investments. Despite only finishing Q1 of 2026, the year is already on track to be the highest on record, already getting very close to 2025's total of $223 billion. So zooming into March here, we saw around $14 billion invested across 147 deals. And as a quick note here, just as I'm sure most of you are aware of OpenAI's recent massive $122 billion raise, just wanted to quickly preface that this was already partially covered in last month's market session as the $110 billion original raise. So instead, we just decided to adjust last month's figures with the additional 12 billion rather than splitting up the OpenAI raise. So just a quick preface there and moving on now, sorry, to the next slide. So zooming in on the mega deals or deals over $500 million. So in March, we saw 6 mega deals, these being Nscale and NextHop AI, which are both infrastructure companies that are aimed to scale generative models. So Nscale here raised $2 billion in a Series C led by 8090 Industries, and NextHop raised $500 million in a Series D led by Lightspeed Venture Partners. Next, we have AMI Labs, which is a real-world intelligence foundational model. Here they raised $1.1 billion in seed funding led by Cathay Innovation. Then we have Arendelle Labs, which is a healthcare and drug development platform, which raised $787 million in venture funding led by Dimension Capital. Next, we have Legora AI, which is an enterprise legal management platform. which raised 550 million in a Series D led by Axel. Then lastly, here we have AR Labs, which is a hardware company that develops optical interconnect technology, which raised 500 million in a Series E. So collectively, these mega deals saw around $5.4 billion in funding, or around 39% of the total March investments. Next slide, please. Okay, so now looking beyond these mega deals, we can see that if we exclude all of these huge outlier deals, investments are quite steadily picking up. So in this light, we can see that March shows a even stronger performance, being the second highest month since the beginning of the study in 2022, with $8.5 billion invested across the remaining 141 deals. And to go a bit more in depth on segmentation here, we can actually go to the next slide. So looking deeper again into March's deal segmentation, we can focus on two segments that received significant investments outside of the mega deals. So here we have cybersecurity, which raised around $1 billion across 15 deals. Notably here, we have 10x AI, which raised around 250 million and is an AI native SOC or Security Operations Center. Then we have Office of the CIO, which raised around $765 million across 12 deals. Here, notably, we have Grafana Labs, which raised as well 250 million and is an observability and monitoring platform. Aside from these verticals, we can also see some other interesting investments in the other category, with an example here being AI Sphere Technology, which raised around 300 million and is a visual model developer, which spans use cases all the way from marketing to security analysis. And on to the next slide, please. So beyond the quantitative analysis, part of our objective as well is to do a zoom in on some use cases we believe are worth having on your radar. So having said that, I'd like to spend some time to talk about Nitra, which is a verticalized Office of the CFO solution specifically for the healthcare industry. So Nitra enables medical offices to maintain efficient operations and optimize cash flows, with some typical use cases being AI procurement management, automated expense coding, insurance eligibility checks, and spend analytics. So overall, Nitra is essentially a platform that enables medical professionals to increase bandwidth and productivity for their dedicated tasks by offloading their financial tasks. So aside from these typical use cases, Nitra sets itself apart, of course, through AI empowerment, which would help with the likes of revenue cycle automation, which would reduce manual coding errors and accelerate insurance reimbursements, automated supply chain intelligence, which analyzes vendor pricing to ensure cost-effective sourcing, natural language processing, which automates documentation and administrative processes, and lastly, claims denial management, which identifies the causes of rejected insurance claims, allowing for faster actioning. So these AI-empowered solutions are progressively growing and further disrupting the way that traditional finance within healthcare typically operates, which is why we believe that cases like these are worth having on your radar. Thank you very much. So I'll give the floor now to Rambo, who will be covering the overview of AI leaders.
Thank you so much, Ignacio. And still on the topic of AI, I'd like to welcome all to the newest edition in our market sessions, where we dive deeper into the AI race, keeping a close eye on Anthropic, OpenAI, and Gemini. For our first slide, we're seeing a model benchmarking, and I'd like to start off with a simple question. Is there actually a winner here in this AI race? The short answer is yes, but the gap is smaller than you think, and it's moving fast. The chart in front of you tracks 3 main AI labs on an ELO score that ranks models based on real users, comparing their outputs side by side. And as of today, Anthropic leads with 1,526 points, followed by competitors OpenAI and Gemini. Now, what does this mean practically? Anthropic is the strongest all-rounder, particularly on everyday enterprise tasks like coding, writing, document analysis. OpenAI has its edge in complex analytic reasoning. And for those who've done a viral photo trend, know that Gemini leads on anything involving images and visual content. Why does this matter? 2 reasons. First, any software company claiming AI as a core differentiator needs to pressure test it for which capability and for which workflow, which we will be talking about in the next slide, because the real answer changes depending on what the business actually does. Second, these scores are shifting every quarter. A moat built on model performance today, it's not a durable moat. The real question for any AI-enabled asset is what sits underneath the model. Is it proprietary data? Is it workflow integration or the customer lock-in? That's what survives the next model release. And on to the next slide, Rambo. This slide captures the most important shift happening in AI right now from an investment standpoint, and that's the one that directly affects how you assess any software business. 2 years ago, even 12 months ago, a business claiming we use AI was enough to justify a premium. Well, that's no longer true. The market's moved on. What matters now is whether that the AI actually is built into the core workflow of a specific industry, not just layered on top as a generic assistant. Now, let's look at what these AI labs themselves are doing. Anthropic has built a prior authorization scale specifically for US healthcare payers. It reads clinical guidelines. It does cross-referencing on insurance codes, and it drafts approval requests automatically. Now, that's not a chatbot. It's an actual workflow replacement. We see OpenAI has GPT-5 embedded directly into electronic health record system that operate under healthcare data privacy agreements. And in the bottom, you'll see Mistral. It has a legal reasoning model trained specifically for contract review and regulatory compliance. So the message for our audience today is that the labs are going vertical and they're going fast. That creates two types of pressures on the software assets. The first would be a competitive pressure. If OpenAI or Anthropic would release a healthcare or a legal product, what happens to the incumbent? And the second is a valuation question. The companies that hold their multiples are those with proprietary data and a deep workflow integration. These are things that labs cannot easily replicate. So therefore today, just being AI powered is no longer enough. Moving on to our last slide here, and it's on partnerships and fundraising. And the timeline here gives you a factual backbone for any AI-related conversation. And 3 things that you should take away from this. 1, the Stargate joint venture at $500 billion is the largest AI infrastructure commitment ever made. It signals that even the people building this tech believe that the build-out is nowhere near done. 2, OpenAI Series F at $730 billion valuation. This is the largest private tech fundraise in history. It pretty much sets a precedence for how the market prices the AI layer, which has a direct ripple effect on software multiples across the stack. And lastly, Anthropic's $30 billion Series G, backed by Amazon, Google, Sequoia, NVIDIA. It confirms that the foundation model layer is consolidating fast around 2 or 3 main players with essentially unlimited capital. So to summarize, the labs are moving into vertical software and they're moving there fast. And the businesses that hold their value are the ones with proprietary data and workflow depth, things that another foundational model cannot easily replicate or replace. That's it for me. I'll pass the ball to Miguel on earnings.
Yep. Thanks, Rambo. And hello, everyone. So on to the next slide then. Next slide. Next slide. Should be this one. Thanks. Yeah, so let me just share just high-level updates we're seeing on valuations per segment first, and then some highlights on remaining companies that released Q4 earnings. So on this valuation per segment chart here in the middle, so comparing to their 10-year historical EV sales, we look at each segments that we're tracking. And since last year, we continue to see premiums from major cybersecurity and infrastructure software. However, these premiums have now lowered, except for majors given their position in the market and growth of cloud. But for the likes of like a ERP, HCM and accounting, cybersecurity, and infra software, these segments lowered as companies in these buckets, like other segments, also got hit by the decline in valuation. But as what we always continue to mention is that what we're seeing here is that these are actually segments where AI sort of expands the demand and also have durability of core platforms as relative defensibility versus AI disruption. So there could be like a part here where there's a small premium gap that can be seen. Moving on to the earnings on the next slide. So 18 companies reported earnings from this cohort. So we it's a rolling basis from Q4 2025. And out of these companies, their stock price performance is almost a split. So you see 10 out of 18 positive, 8 out of 18 negative. And despite 16 of them or majority of them beating consensus, while the other two are in line with consensus. So this continues to be the narrative from earnings from late last year as the market sentiment has shifted on the vertigo of which companies can continue to provide strong guidance and are prepared for this like agentic platform cycle. On to the next slide. So we've listed some highlights on each of the company, but to sum it up, like here are some key themes we're seeing from this cohort of earnings. So you can read this more offline, but three key takeaways here. So first one is really this AI paradox. It's a paradox because AI has that effect of having record revenues, but also record layoffs. And we have a slide for this later on. But you look at Oracle, posted one of the strongest quarters in its history. Cloud infra was up 84% year on year to 4.9 billion US. Its remaining its RPO reached 553 billion on the back of AI contracts with Meta, Nvidia, OpenAI, and XAI. And they even raised their guidance to 90 billion for the next fiscal year. Then, Oracle laid off an estimated 20,000 to 30,000 people, roughly 15 to 18% of its workforce. Reason here is very straightforward, right? Like Oracle is spending 50 billion US in capex this year on AI infra, funded by a 50 billion debt and equity raise, while free cash flow through the first 3 quarters was negative 44 billion. So those layoffs alone could generate an additional 8 to 10 billion in incremental free cash flow for them. And management explicitly cited AI-driven code generation as reducing the need for certain roles within the company. One thing here is that Salesforce did the same in February, cutting roughly 1,000 roles across marketing, product management, and even the Agent Force AI team, on top of the 4,000 support roles they already eliminated in late 2025. So what we're seeing here is basically that we are sort of entering a period where the best performing software companies will continue to grow revenue while shrinking or optimizing headcount here. Second theme we're seeing is that the importance of sustained growth acceleration in cybersecurity amidst consolidation. So what do I mean here? So if you look at the cybersecurity bucket here, so CrowdStrike, Okta, SentinelOne, Rubrik, 3 out of 4 of them have positive stock price performance after post-release. And cybersecurity is one of the strongest buckets in this cycle, actually. CrowdStrike, total AR crossed 5 billion US already. Okta with new products driving 30% of bookings at a 40% contract uplift. And Sentinel One crossed 1 billion US in revenue, hit full year profitability, and now has 65% of enterprise customers using 3 or more products. What connects these three is platform consolidation. So the average large enterprise still runs on 60 to 80 security tools from dozens of vendors, and that number is compressing fast. And AI is sort of accelerating this. So you see from CrowdStrike's Charlotte AI, which is built on the Falcon platform, Okta's identity threat detection, and SentinelOne's Purple AI. This makes consolidation economically more compelling for these companies. And so why was Rubrik the only red name here? So despite it having actually the highest revenue growth, so 46% revenue growth and a 10% beat on consensus, it's because their next year fiscal year guidance implied growth decelerating to just roughly 21%, and the stock was already down 48% from its highs. The market has actually zero tolerance for growth deceleration at premium multiples, even when the beat is strong, like as you can see with Rubrik. This tells us just how much of a sector's valuation is built on basically sustained acceleration and not just on the current fundamentals of the company. Last key takeaway here is on infra and why AI adjacent isn't enough. So if you look at one infrastructure company here you're all familiar with is MongoDB. It has been crushed. So MongoDB was nearly down near 19% despite revenue growing 27% to 695 million US and Atlas adding a record 114 million in net new revenue. So three things, right? Three things went wrong for MongoDB. Next fiscal year guidance implied 16 to 18% growth versus the full year 2026 fiscal year growth of 23%. So it implied again a slower growth as deceleration in growth. Atlas growth also decelerated to 29%, which is still high. But if you look at from peers like Snowflake, they guided faster growth at around 30% or more. And third is they recently changed leadership and CEO. So market sentiment was uncertain on this shift. That could be attributed to revenue growth slowing down. But the more interesting key takeaway here is very structural, right? So MongoDB sits in infrastructure where AI should be a tailwind. So more AI workloads means more data, which means more databases, which is good for MongoDB. Yet the markets, it's now drawing this sharp line between companies where AI is directly creating new revenue, as can be seen with Oracle and contracted AI infra, or with CrowdStrike's Charlotte AI reducing customer SOC costs. And companies where AI is a background benefit that shows up in the narrative, but not yet in the growth rate. So MongoDB is in the second camp where AI apps run on it, but it doesn't directly monetize AI. So rising AI usage doesn't necessarily drive proportional revenue growth for MongoDB, since MongoDB gets paid based on application data usage and not on AI demand automatically. So this doesn't automatically mean more revenue for MongoDB. And when MongoDB signaled that growth deceleration, this narrative of them being following that AI as a tailwind for them doesn't really follow that narrative. So three themes we're seeing here, right? Like AI is driving both revenue growth and workforce cuts simultaneously. Platform consolidation and sustained growth is very important in cybersecurity. And lastly is AI adjacent is not necessarily AI driven, as you can see with MongoDB. As mentioned earlier on the layoffs, maybe we can hop on to the next slide. So as mentioned on comments on layoffs on Oracle and Salesforce, we already view that Q1 2026 restructuring across these large software companies are a major structural inflection point rather than standard cyclical cost cutting as we've seen in the past years. So what we're seeing is that management teams are increasingly utilizing this human capital optimization as the primary funding mechanism for their next gen AI capex cycle. So three main shifts happening here, right? So OPEX to CAPEX reallocation. So headcount reductions reaching at around 40% at Block and around 18% at Oracle shows this very deliberate sector-wide reallocation strategy. So companies are actively dismantling this legacy OPEX structure to finance their very highly capital-intensive AI infra, data center buildouts, and proprietary model development, like with Meta's Llama pipeline. Second is this market pressure accelerating AI implementation. So the competitive moat in enterprise software is rapidly narrowing. So you see this intense market pressure forcing management teams of these very large companies to aggressively implement AI capabilities just to maintain terminal growth rates. So companies like Atlassian are explicitly utilizing FTE rationalization to self-fund their future AI enterprise software development to avoid falling behind the innovation curve. And lastly is basically this full transition or part transition to what we call an intelligence native operating model. So the adoption of AI for core engineering or code generation and go-to-market functions a secular shift. So as WiseTech mentioned here, the era of manually writing code is over. And Oracle suggests that traditional human capital heavy model for scaling software platforms is effectively obsolete. Yeah, so those are the key takeaways that we're seeing here on the layoffs.
Thanks a lot, Miguel. And just a small word on this, it's what companies bring to market officially, but obviously it's also what the market wants to hear as well. So this is the official news. Probably there's a lot of like optimization going on at the back with some of these companies needing to defend their margins and so on. Thanks a lot for taking the time to be with us today. Hope it was informative and helpful. Looking forward to seeing you again in a few weeks. Thank you all. Bye-bye.